Hello, this is just an introductory remark. We will start in approximately 2 minutes, being 3/10 of a billable hour for most of you. The presentation, Tax Treatment of Expenses Paid with PPP Loan Funds, has already won several awards and will not qualify for continuing education credit. We can see your cameras, so please, no nudity unless you are attractive. So any questions can be posted to the question box and will probably be ignored unless they are incredibly easy to answer. Happy Thanksgiving, and we hope that you enjoy the show or that at least it's not too bad. For those of you who have just joined us, I would run away just as fast as you can. In fact, that's what I recently said to the gingerbread man. The program will begin in approximately 1 minute. It does not qualify for continuing education credit or as psychological counseling. Look to your right and to your left. The person next to you will not be here 1 year from today if you are in law school. If you're not in law school, that's pretty smart. Also, the program will begin in 30 seconds. Please do not rustle wrappers or spill Coke on the seats. Thank you. Hi, this is Alan Gassman. I'm here with Brandon Ketron and some dummy, and we're going to talk now about tax treatment of expenses paid with PPP loan funds. As always, you can please send us any questions you like, either on the platform here or by our emails. Send me the easy questions, send Brandon the hard questions, and no one will get hurt. Just want to mention, if you are still calculating PPP loans, especially because you have more than $50,000 PPP loan and reduction in FTEs or in compensation, you might want to consider the Lineberg System PPP Excel spreadsheet. There is a money back guarantee. If you're not 100% satisfied, they will cheerfully refund your money. There are YouTube videos here, not the best YouTube videos you ever saw, but not bad either, that you can watch to learn more about PPP programs. Wanted to mention a lot of these LISI year-end tax planning programs that we're working on. Friday, December 4th, we're going to talk about the recent bankruptcy law changes. And here we go. Brandon, take it away.
Yeah, so just to start off, just to talk a little bit about the PPP process. So we all know that we got PPP loans that are currently outstanding. And a common question we get is, when do I have to apply for forgiveness? So I wanted to just touch base on this to begin with. And you have 10 months from the end of your covered period to submit your application. And then once you submit it, your lender has 60 days to review it, take a good faith look at it, confirm your calculations, and then pass it along to the SBA. Then the SBA has 90 days from that point to review it and submit their final decision on whether or not the loan is forgiven. So what this does is it creates uncertainty for us now in 2020. We know the expenses aren't going to be deductible, but we're likely not going to get forgiveness until 2021 just because of this timeline. So wanted to point that out. It could be up to 150 days after you submit your application before you get approval from the SBA on the forgiveness amount. So to address that issue, the IRS did issue this Revenue Ruling 2020-27 to try to answer some outstanding questions regarding that forgiveness process. So they had Notice 2020-32, which says you can't deduct expenses to the extent that they were payable for the PPP loan and the PPP loan is forgiven. So the question was, if I don't know if I have that forgiveness in 2020, are they still not deductible? Or can I just wait until I get confirmed forgiveness in 21 and then deduct them or not deduct them at that point? Well, what the revenue ruling says that if you reasonably expect to receive loan forgiveness, then you're required to not deduct the expenses in 2020. It cites the Internal Revenue Code Section 265 as support of that, and some other tax court cases here. Brunette versus Commissioner is one. Basically, if you have a reasonable expectation that you're going to recover or receive some type of reimbursement for expenses paid with PPP funds, then they're not going to be deductible in 2020.
According to the IRS.
According to the IRS. So they did give us two pretty good examples. Example one, business A spends all the loan money in 2020 on permitted expenses. It submits its loan application prior to the end of the year, but it doesn't get that confirmation before December 31st. But the expenses still aren't deductible because they had that reasonable expectation of reimbursement. The IRS is saying that because you're filling out the application, filling in all the numbers, you know what you've spent because your covered period can't extend past the end of the year anyway. So we should have a general idea and a reasonable expectation of what we've spent and what will be forgiven. And because of that, we can't deduct those expenses. And then in the second example here, this even applies if you don't submit your application before the end of the year. If you wait until 2021 and submit your application, you still know what you've spent. You still have that reasonable expectation of forgiveness. So you're not going to be allowed to deduct the expenses. So Alan, before we go to the revenue procedure, any initial comments on 2020-27 and what the IRS has done here?
Well, I think the first thing to point out is I don't think that Congress is done yet, because there are many, many angry taxpayers, and there are many congressmen and senators who don't want to see people have to pay a big tax bill this year. So we don't know when there might be corrective legislation. But when Congress acts, the president signs a bill that says we will give these loans to you, and when we forgive these loans, there will be no tax on the forgiveness. If they had known or thought that the IRS would apply Section 265 at the time the law was passed, I think they would have neutralized it. I don't think it was the intent of Congress that this would occur, because this is the equivalent of taxing the entire PPP loan. When you get into this type of situation, there is definitely a timing issue. I don't think we can be absolutely sure that Section 265 applies here. If Section 265 does not apply here, then you have the tax benefit rule to apply, and the tax benefit rule would probably not apply until the following year, when you make sure that you know that your loan is forgiven. So, that's what we're hearing a lot about. That's what people are studying, researching, and trying to determine whether there is any way to rationalize having the loss of the expense next year as opposed to this year. On the other hand, a great many taxpayers are in a much lower tax bracket this year than they're going to be in next year. First of all, because the economy has not been kind to them so far this year for a lot of people. And secondly, we have a very, very small possibility of a tax rate increase next year. I think the proper thing to tell clients is that it is sure looking like you have lost these deductions for 2020, but we are not going to be absolutely sure until we file your return in 2021. What do you think about that, Brandon?
Yeah, no, and I agree. And I think that, the prudent thing to tell clients at this point is that essentially your PPP loan is taxed as if the entire loan was income. Because if the entire loan's forgiven, that means you've paid, let's say you had a $500,000 loan, you've paid $500,000 of expenses that are now not deductible, which in a way results in $500,000 of additional taxable income in 2020. So I think that's going to be an unexpected result for a lot of clients that haven't really been closely following the PPP and what's happened here. So we make sure that they're aware of that and make sure they're planning accordingly to pay that tax or to not have as big of a loss as they might have expected previously. So then the IRS also issued with the revenue ruling a revenue procedure that basically tells us, well, what happens if I was expected forgiveness and I didn't deduct these expenses in 2020, but now it looks like I don't get forgiveness. What are my procedures and how do I correct this, mistake? And, first of all, you have to meet the requirements is one that you actually didn't deduct the expenses in 2020 because you expected the wrong forgiveness. You submitted the application or you intend to submit the application after 2020. And then after that, you either were notified that you didn't get the forgiveness that you were expected, or that you just decided not to seek forgiveness at all. And that might be more common than you might expect. There's a lot of, especially for the larger loans, those clients that are concerned with a necessity issue may just decide to return the loan amount rather than having to worry about this new necessity questionnaire that the IRS has or the SBA has issued to audit this necessity standard. So you might see more clients returning funds, and then that would result in the expenses being deductible. But if you do meet those criteria and you later find out that your entire loan's not forgiven, you have two options, and one's to deduct it on 2020 or file an amendment to your 2020 return and deduct it, those expenses on the 2020 tax year. Or you have the second option is deducting the expenses when you actually get confirmation that forgiveness is denied, which might be in 2021. And as Alan mentioned, we're really looking at the possibility of higher rates, so probably better off deducting those in 2021 if you can. So just look at these options, figure out which one makes the best result for your client. There's other complications as well, just besides tax rates, but take a look at it, analyze the situation, and determine which year might be better to deduct the expenses. Now, if you are going to rely on this procedure and the so-called safe harbor to deduct the expenses, you have to include this statement with the return that you're deducting the expenses on. So if that's an amendment to your 2020 return, it's got to be with 2020. If you're deducting them in 2021, it goes with your 2021 tax return. So I won't go through in detail here what has to be included, but it's here for your reference. Make sure that this is appropriately addressed on the tax return. The revenue procedure has a sample statement as well that you can look at to include with the return.
Let me
go ahead, Alan.
Before we go into this and before we forget, we should probably add a page for this. What about an independent contractor or sole proprietor who got $20,833 on $100,000 of Schedule C income or less than that? They don't have to spend anything to get their forgiveness. How do you rationalize taking their deduction away when they might not have a tax deduction? Or if they do, what happens?
I could be completely wrong on this. This hasn't been addressed in any guidance, but my view of this and what I've learned from my research is that if you don't have any employees and you're really just taking that owner compensation replacement, you don't get an expense for paying yourself as a Schedule C taxpayer. It's just income to you. And this owner compensation is going to be income to you anyway, regardless of whether the loan is forgiven or not. So I don't think there's really any adjustment as far as what expenses are deductible and non-deductible for a Schedule C taxpayer that has no employees and is just taking that $20,833 owner compensation replacement. Where it can get tricky though is if you do have employees and you are paying expenses with the PPP funds, then that's going to cause those expenses to be not deductible. The wages paid to those employees with PPP funds not deductible. Even if you don't have employees and you might have to, for some reason, pay rent or utilities or interest expense with the PPP loans, then those wouldn't be deductible, but the owner compensation replacement itself, I don't think there's any adjustment because of it.
Well, that's good news for a lot of people.
Mm-hmm.
Could you take that same position on loans of less than $50,000?
I don't think so, because it depends on the taxpayer. I mean, if you're, a an S corporation, you're getting an expense for the wage paid to the S corporation shareholder. That's paid with PPP funds. So that expense for the wages to the shareholder would not be deductible because they're paid. Where the difference is Schedule C taxpayer, you're not getting the expense. It's just income to the Schedule C taxpayer.
I see.
All right. You want to talk about 265 and how it may not apply?
Sure, sure. So Internal Revenue Code, Section 265, if you read along with me in the second line here, wholly exempt from taxes imposed by this subtitle. So the question here is, do those words, this subtitle, refer to income and expenses under the Internal Revenue Code, which is the subtitle referred to, or does it refer to expenses, income from outside of the subtitle? So if these words, if the words this subtitle mean that when the income is for any reason exempt from taxes imposed by the subtitle, the deduction will be lost. But if they have the other meaning, the deduction will not be lost. I think it's most likely that the deduction will be lost here, but at least that is an issue, and we have not found any case law on it as of yet. What do you think?
Yeah, it's one of those where you could take a literal reading of it and say, okay, well, maybe 265 doesn't apply because we're talking about an exemption from income that's outside of the Internal Revenue Code subtitle and under the CARES Act, which was under the SBA provisions under Title 15. So completely out of the income tax code. That could be one reasonable position to hang your hat on and say that I'm deducting the expenses anyway, and taking your chance that maybe Congress would confirm that, in 2021 and you're in the clear. I think this would require a disclosure statement on the return if you are deducting the expenses and you think that you have a reasonable expectation of forgiveness. So you might want to consider disclosing that you are deducting the expenses on the return to avoid penalties later down the road. But certainly one area that could be a potential challenge to the ruling. And Alan, I don't know what type of authority revenue rulings have, but they're certainly not binding. Or very large authority compared to like a Supreme Court case or a statute. So I think you can definitely disagree with the way the service interprets the law.
Well, I think if you're going to disagree with this one, you're going to have to make a very notable disclosure on the tax return, and you're asking for an audit and a challenge.
Yeah.
I think a lot of people will go ahead and file this according to the revenue ruling and then file a protective claim for refund within 2 years of when the return is filed. So you might get your money back if you win the lottery of litigation that might arise here, without being in a potential penalty situation. We don't prepare income tax returns, but if I was a return provider, I don't think I would be signing a return without making very significant disclosure and having an opinion letter. And our firm's not going to be writing these opinion letters. There is one LLM in taxation who has a website from before this revenue ruling came out, who specifically indicated that he is offering opinion letters, in this area. I'm glad I'm not his malpractice insurance carrier, but an aggressive client may want to seek out a law firm like that. Mm-hmm. But even if Section 265 doesn't apply, it sure appears that the tax benefit rule would apply. And if the tax benefit rule applies, then you lose the deduction in 2021, not 2020, which might help some people with their cash flow. What are your thoughts?
Right, and I think that's the idea, is maybe we can get out of 265, but the tax benefit rule is really going to catch us regardless, I believe, because you're getting a reimbursement for expenses paid that aren't paid out of your pocket. So they probably shouldn't be deductible, and the IRS probably got this right, but it would be nice if it would happen in 2021, and you just have to take the analysis and say, okay, is it really worth the risk for the difference in maybe a couple of percentage points in tax rates to take the deduction in 2021 or to not deduct them in 2020?
Yep. And maybe you try to get your client's income under $400,000. So if Biden cuts a deal that says everyone with income under 400 gets the deduction, everyone with income above 400 doesn't get the deduction. Mm-hmm. What are the chances of that? 1%, 2%, 3%? But It's going to be an interesting tax planning year for all you CPAs. Thanks for what you do. It sure hasn't gotten any easier. So what about the basis in an S corporation? When I get a $100,000 loan, that's not income. So does my basis go up? My basis goes down when I have the expense, but if the expense isn't deductible, does my basis go down? It's
Yeah, this is one where it's really unclear right now, and I think this is another area where guidance is needed from the service on how this is really treated for basis purposes. I was doing a little research last night on this issue and was able to find some articles on this, but I think a lot of people are trying to stay away with it because they don't really know the answer either. But from what I was able to find, it seems like it should be treated as a basis increase for partnerships, but it's not going to be at risk because the debt's not recourse. There's no personal guarantees. So it may be able to increase your basis so you can make some additional distributions, but it's not going to increase your basis so you can take losses because of those at-risk limitations that apply in partnership taxation. For S corporations, maybe a little different, maybe not a basis increase because this isn't a shareholder loan. There's no guarantees, there's no recourse available to the SBA to recover the loan, there's no collateral. So it's unlikely that the S corporation gets an increase in basis, but I was able to find one article that made an interesting point. There's a Supreme Court case called Gitless v. Commissioner. And under that case, the taxpayer got a basis increase from discharge of indebtedness income that was excluded from income under Section 108 because of insolvency, I believe. So it was not taxable income, but it was income just excluded, which is almost a similar way that would apply under the PPP loan. Now, after this case was decided, Congress amended Section 108 and added that it wouldn't be included and wouldn't result in a basis increase if the income was excluded under Section 108. But under PPP land, we're not excluding the income under Section 108. It's just not included in income altogether, and it doesn't fall under one of the exceptions. So you could take the position that once the income is forgiven, that it does result, or once the loan is forgiven, that it does result in an increase in basis as income, just not taxable income under this Gitless v. Commissioner case. But then I think you're likely reducing your basis by the non-deductible expenses. So it's really just a wash for basis purposes in the end, I think, is the result. But we'll see what the IRS says about this, if there's any more guidance issued. But be aware that it's really unclear now how this affects basis.
So CPAs who do planning for year end need to be sure that the client has enough basis in the stock of an S corp to allow losses to pass through.
Right.
So this is going to be an important issue, and I hope we get some guidance from the IRS much sooner rather than later, since we're we have 5 weeks left.
Yep.
Until yeah
35 days.
Right. And for those of you who are friends of mine, there's not that many shopping days between now and the first day of Hanukkah. So get going here. Should we mention Section 199A since we wrote a book on it and no one cares about it anymore?
Yeah, so another issue here that hasn't really been addressed, but Tony Nitti, writes a Forbes blog, great blog. If you ever have an income tax issue, search and see if he's wrote an article on it, because most of them are right on point and very easy to read. But he made an interesting point that says when you're talking about wages for purposes of the 20% deduction, we know that you have to have a certain amount of wages if your income exceeds certain thresholds to qualify for the full deduction. Well, if those wages are non-deductible, then are they really included in the calculation of qualified business income? So do we have to not count those wages for purposes of computing this 50% W-2 wage limitation that applies for the 199A deduction? Maybe. I don't think that's what Congress intended, but be aware that this could be a potential issue. So just to look at it from an example standpoint, if you had $500,000 of wages paid during the year and 200,000 of those were paid with PPP funds, then you might only have 300,000 of wages that count towards that W-2 limitation that applies to Section 199A income. I don't know that that's the case, but it is a potential issue to watch out for, and hopefully would be clarified before we have to start filing tax returns.
So
And
again, just to, when you see here on page 19, if you had a company with $1 million net income and it's not a specified trade or business, let's say it's a widget manufacturer, you would need to have a certain amount of wages paid in order for the shareholders to take the 199A deduction. And even if you pay those wages, if you paid them with PPP money and your PPP money that you paid them with was not deductible because of this new ruling, then read literally, you would also lose your 199A deduction. So when your PPP money was spent, let's say you spent it 65% on wages and 35% on interest, rent, and other things, is the deduction loss allocated among these things, or is it the worst first, or is it pro rata? And nobody's tax return software is going to take this into account. So these calculations are going to have to be done by hand. I don't know if we should develop a spreadsheet for that.
Yeah,
what's going to happen with this?
Thinking about this, a lot of people now are just really using wages and payroll costs to report their forgiveness and not worried about interest, rent, utilities. But if it becomes the case where that reporting those and taking forgiveness on just taking payroll cost might result in the loss of a 199A deduction, maybe you want to go back and on your forgiveness application only shows 60% payroll cost and 40% interest, rent, and utilities. So then you have more wages that might count towards, your Section 199A deduction if they are indeed lost as a result of the forgiveness.
And then to the extent that you still don't have enough wages for your full deduction, pay more wages, but then you pay wage tax. So we should really work out an example. By the way, before I forget, when are we giving the webinar for Lissy with Jerry Hesh?
November, let's see, it is next Thursday, so December 3rd.
Okay, we should have put an advertisement here, but we are doing a webinar with Professor Jerry Hesh on this. What time and day is it again? One more time.
It's on December 3rd, and it's at 3 o'clock.
3 p.m. So we're going to be a lot smarter then. We're going to do 90 minutes. Professor Hesh is doing a lot of research and reading some law review articles, and maybe we'll end up writing another article with him. But whatever we write with him, we'll distribute to everybody who is on this webinar. So Brandon, is there anything else we should cover, or should we go over questions? We've got about 4 minutes left and about 47 questions.
Yeah, let's take some questions. I think that's probably better use of time than trying to fly through the rest of the slides.
Yeah. Okay. So what happens if you're a Schedule C shareholder, no employee payroll, no expenses to deduct? Is the loan forgiveness taxable? And we think the answer is yes. We don't have any idea how we got that answer, but we do.
The Schedule C is taking an owner compensation replacement that's essentially replacing their lost income. So I think that income, it is going to be income to the Schedule C taxpayer as the compensation replacement.
That's exactly
the wages paid would be compensation to the employee.
Yeah. Now here's somebody. I have several clients who have already been forgiven. I'm not going to redo all of their books to remove each expense that isn't deductible. Instead, I'll make one line item in the return to add back the total that was spent with PPP funds. Well, I don't know if you can do it that way or not, but if you pay the right amount of taxes, I don't know that the IRS is going to complain.
Yeah.
It would be interesting to see if they issue a new schedule to be attached to a tax return where you'll have to calculate this.
Yeah, and I think it makes sense that they probably will end up doing that, but we haven't received it yet if they are.
Okay, how should someone treat taxpayers with a fiscal year end of September 30, 2020, when their 24-week period did not end until October 22nd, 2020? Expenses claimed on the forgiveness application are being paid over 2 taxable years.
Mm-hmm.
What are your thoughts? Well, I think you should just fire all the clients who have a fiscal year ending during the 18 or 24-week period. Just refer them all to Kevin Cameron and let him figure it out. They'll never forgive him. But I think, go ahead, Brandon. What do we?
Yes. So if under the reading of 265 and the sites that's in these revenue rulings, it says they're non-deductible when paid. So if you had 50% that were paid in, tax, let's call it tax year 1, and 50% paid in tax year 2, then you just not deduct 50% in tax year 1, and you don't deduct 50% in tax year 2. I think that's the way to look at it from when they were paid or accrued standpoint, and that's when they're non-deductible.
Okay, that's very good. Now then, we've got like 9 questions. It says, I'm confused. Are you saying that a Schedule C taxpayer with no wage who received $20,833, will that be added to their Schedule C income for 220 or not? And the answer is no. We think that they got a good deal here, which makes sense because they were treated terribly under the initial regulations, because they couldn't get anything for their health costs, they couldn't get anything for their payroll tax costs. Now they have the last laugh. They are going to get this tax-free, we hope. Oh, here's a good one. Maybe challenge under equal protection based on the Schedule C independent contractors being treated differently. I don't know anything about the equal protection law other than that I did pass constitutional law when I took it in 1980, but we will certainly look into that and see what this is about. Now, somebody said, and a friend of mine, thank you very much, Dale, that's only a revenue ruling. Well, a revenue ruling is pretty tough stuff. That is the pronounced opinion of the IRS. It's a well-written ruling. It quotes some case law that is very analogous. So I'm not taking this one lightly at all. Brandon, do you see any questions that we should go over? I think we've answered all of them, except for the one here asking for your autograph.
Yeah, I'm not seeing any others. I'm scrolling through here.
Well, what a coincidence that we would end this exactly on time. We appreciate all your support and all of your readership of our articles. We'll be sending an update as we get smarter on this, at least one update. You've got our email addresses, so please feel free to keep us posted, and we will keep you posted. Brandon, any final words?
I don't think so.
Happy Thanksgiving, and please stay healthy and safe. Thank you.